Good morning, everyone. This is Francis Kaliwan, and I will discuss investment in debt securities. Our discussion for this particular topic will be guided by the provisions of IFRS 9, Financial Instruments, IAS 32, Financial Instruments Presentation, and IAS 39, Financial Instruments Recognition and Measurement. So before we proceed, let us have these learning outcomes first. Number one, we are going to define financial instruments and financial assets. Actually, the definitions are provided for by the standard, and also we are to describe the nature of the instruments and assets. And also, we are to classify investment in debt securities. So again, this is provided for by the standard, specifically IFRS 9. Also, number three, we are to measure investment in debt securities at initial recognition and subsequent to initial recognition. So essentially, we are going to determine the cost of the investment in debt securities at initial recognition and the measurement or the cost of the investment in debt securities at the end of the accounting period to be presented on the statement of financial position. And then we are also to account for the different transactions affecting investment in debt securities, such as but not limited to the receipt of interest, the recording of amortization if there is any for discount or premium, the recording of the changes in fair value for fair value classification of investment in debt securities, and the recording of the disposal of investment in debt securities. And finally, the presentation of the investment in debt securities in the statement of financial position. So let us define now financial instrument according to IAS 32. A financial instrument is any contract that gives rise to a financial asset of one entity and a financial liability or equity instrument of another entity. And the entity that recognizes financial asset is what we call the investor, while the entity that recognizes financial liability or equity instrument is what we call the investee. So essentially, if a company purchases, say for example, bonds of another entity, the buyer or the purchaser of the bonds um, will recognize in its books financial asset, that is investment in bonds or investment in debt security, whereas the corporation who issues the bonds or who sells the bonds will recognize in its books financial liability or bonds payable. Whereas, when we talk about equity instruments, so this is accounting for shareholders' equity if you are the ones issuing the shares. Whereas if you are the ones buying the shares, you are to report that in your statement of financial position, in your books, also as financial asset. You will also be called investor. So, investor reports financial asset, whereas investee reports or recognizes financial liability or equity instrument. And also, IAS 32 provided that an entity shall recognize a financial asset or financial liability in its statement of financial position when and only when the entity becomes party to the contractual provisions of the instrument. And now, after defining financial instrument, let us also define financial asset. So, according to IAS 32, financial asset is any asset that is cash. So, cash is a financial asset. That's the number one or the most common example of financial asset. An equity instrument of another entity. So, as I've mentioned a while ago, if we are investing in the equity instrument of another entity, we recognize a financial asset. And finally, a contractual right, so based on contract to receive cash or another financial asset from another entity, or to exchange financial asset or financial liabilities with another entity under conditions that are potentially favorable to the entity. It's favorable because we are the ones receiving cash or financial asset. The most common example of um, financial assets other than cash is an investment in security. So a security is an interest or a share in a debt or equity of another entity that is represented in a financial instrument and is one that is being dealt with in capital markets. So as I mentioned, securities are either debt securities or equity securities. Debt securities are instruments representing a creditor relationship with an enterprise. They are instruments that typically have the following characteristics: maturity value, periodic interest payments at a fixed or variable interest rate, and maturity date. Debt securities include government securities, corporate bonds, government bills and warrants, convertible debt, and commercial papers, among others. Whereas equity securities are those that represent ownership in a company or rights to acquire ownership interests at an agreed upon or determinable price. So equity securities include ordinary shares, preference shares, share warrants or stock rights, call options, and put options. The substance of a financial instrument rather than its legal form governs its classification as to whether the instrument is an equity or debt. For example, a preference share that provides for a mandatory redemption by the issuer for a fixed or determinable amount at a fixed or determinable future date gives the holder the right to acquire the issuer to redeem the instrument at or after a particular date for a fixed or determinable amount. And therefore, it is appropriate to classify that as debt security rather than an equity security. So now let us discuss the accounting for investment in debt securities. So the very first lesson that we should learn in accounting for investment in debt securities is the classification of the investment. So for accounting purposes, debt securities acquired by an entity are classified as debt investment at amortized cost, at fair value through other comprehensive income, and at fair value through profit or loss. And the classification of debt securities shall be made on the basis of both, number one, the entity's business model for managing the financial instrument or the financial asset, and the contractual cash flow characteristics of the financial asset. And these two must be satisfied for us to properly classify an investment in debt securities. So now, for us to understand better the classification of investment in debt securities, let us have this table. So again, the classification of debt securities shall be made on the basis of both the business model for managing the financial asset and the contractual cash flow characteristics of the financial asset. So first, the business model. So the entity's business model is determined at a level that reflects how groups of financial assets are managed together to achieve a particular objective. So business model refers to how an entity manages its financial assets to generate cash flows. And this business model shall be applied at the portfolio level and not on an instrument by instrument approach. However, an entity may adopt more than one business model to manage its financial asset. So, an entity's business model for managing financial asset may be number one, um, just collection of cash flows that are solely payment of principal and interest, or selling financial assets when opportunity from profit taking arises because of fluctuations in fair values and interest rates, or both collection of cash flows that are payment of principal and interest and selling the asset when opportunity arises. So, applying that concept, if the business model of the company or the entity is to collect contractual cash flows and the contractual cash flows are solely payments of principal and interest on principal, then the proper classification is investment in debt security at amortized cost. Whereas, if the business model of the company is both to collect contractual cash flows and to sell when opportunity arises, then the proper classification is at fair value through other comprehensive income. Now, if the investment in debt security is not classified as investment in debt security at amortized cost or investment in debt security at fair value through other comprehensive income, IFRS 9 provided that the classification shall be investment at fair value through profit or loss, or if the debt investment is held for trading purposes, then the classification also is at fair value through profit or loss. Now that we're through with the classification, let us discuss the initial measurement of investment in debt securities. So according to IFRS 9, at initial recognition, an entity shall measure a financial asset at its fair value plus or minus, in the case of financial asset not at fair value through profit or loss, transaction costs that are directly attributable to the acquisition or issue of the financial asset. Meaning, if the classification of the debt security is amortized cost or fair value through other comprehensive income, the initial cost is fair value plus or minus the directly attributable transaction cost. Whereas, if the classification of the investment in debt security is fair value through profit or loss, transaction cost directly attributable to the acquisition or issue is not added or deducted to and or from the fair value. The transaction cost is expensed outright on the date it is incurred. However, if the fair value of the financial asset at initial recognition differs from the transaction price, because the best evidence of the fair value of a financial instrument at initial recognition is normally the transaction price. So again, if the fair value differs from the transaction price, the entity shall recognize the difference as a discount or premium. So to summarize, the initial measurement of the investment in debt securities, let us have this table. So if the classification of the investment in debt securities is at amortized cost or at fair value through other comprehensive income, the initial cost is fair value plus directly attributable transaction cost. And the difference between the fair value and the transaction price is recorded as either discount or premium, which will be amortized over the term of the debt security using the effective interest method. Whereas if the investment in debt security is classified at fair value through profit or loss, the initial cost is just the fair value or the transaction price. Any transaction cost directly attributable to the acquisition is expensed outright. And if there is difference between the fair value and the transaction price, which is called discount or premium is not amortized. Now, how about the subsequent measurement? According to IFRS 9, after initial recognition, an entity shall measure financial asset in accordance with its initial classification, whether it is classified as amortized cost or at fair value. So, if the classification of the investment in debt security is amortized cost, then the subsequent measurement is amortized cost, which is defined in IFRS 9 as the amount at which the financial asset is measured at initial recognition minus the principal repayments, plus or minus the cumulative amortization using the effective interest method of any difference between the initial amount and the maturity amount, and adjusted for any loss allowance. Whereas if the classification of the investment in debt security is at fair value through other comprehensive income or fair value through profit or loss, the subsequent measurement is at fair value. And now let's discuss the concept of investment income from investment in debt security, which is called interest. So the interest from the financial assets are recognized as follows. If the classification of investment in debt security is at amortized cost and at fair value through other comprehensive income, the interest received is determined by multiplying the nominal rate to the face value of the financial instrument. And the interest revenue or the interest income is determined by multiplying the effective rate to the carrying value of the financial asset at the beginning of the year. Whereas if the classification of the investment in debt security is at fair value through profit or loss, interest received and interest revenue or income are the same, and it is determined by multiplying the nominal rate to the face value of the financial asset, meaning we will not consider the effective rate of the financial instrument. So next is the accounting for unrealized gains and losses. So these are called unrealized gains and losses because we are not referring to the gains or losses due to disposal. These are the gains and losses due to the change in fair value of the financial statement from year-to-year movement in fair value. So unrealized gains and losses due to changes in fair value on a financial asset that is measured at fair value. So for investment in debt securities classified at amortized cost, this is not applicable. So we do not recognize unrealized gains and losses for amortized cost investment. So that is measured at fair value shall be recognized in profit or loss or in other comprehensive income depending upon the initial classification. So if the investment in debt securities is classified at fair value through other comprehensive income, unrealized gains and losses are recognized in other comprehensive income and accumulated in equity, meaning the annual change. When we say annual change, it's the difference between the fair value at year end for the current year and fair value at year end of the previous year. So it's the change in fair value for the year. They are recognized in other comprehensive income as component of the statement of comprehensive income, and they are accumulated as holding gains and losses in equity. Whereas if the classification is of the investment in debt security is at fair value through profit or loss, any change in fair value is recognized also in profit or loss and is not accumulated anywhere in the financial statements. So now let us discuss realized gains or losses on the disposal of investment in debt securities. So the gains and losses arising from the disposal of the investment in debt securities are recognized in profit or loss regardless of the classification. So whether the classification of the debt security is at amortized cost, at fair value through other comprehensive income, or at fair value through profit or loss, any gain or loss as a result of the disposal or sale of the investment is reported in profit or loss. So in investment in debt security at amortized cost, the computation of gain or loss is net selling price less the carrying value, which is actually lifted from the amortization table. And the carrying value from the amortization table to be used in the determination of gain or loss must be the updated carrying value, meaning it is adjusted for any discount or premium amortization, especially if the date of disposal or date of sale does not coincide with the end of the accounting period. And for investment in debt security at fair value through other comprehensive income, the computation actually of the gains or loss on disposal is simpler because whatever is the accumulated holding gains and losses in equity during the um, lifetime of the debt security at fair value through OCI is recognized as the gain or loss on sale. So it is actually called recycling, no? So any unrealized holding gains and losses accumulated in equity is recycled as the gain or loss on sale of the investment at fair value through OCI. So no additional computation for the gain or loss. And finally, for investment in debt security at fair value through profit or loss, the computation of the gain or loss on disposal is similar to the computation of gain or loss on disposal in investment in debt security at amortized cost. It's net selling price less carrying value. The only difference is that the carrying value here is not based on the amortization table because we do not prepare amortization table for investment in debt securities at fair value through profit or loss because as I mentioned a while ago, we do not amortize any discount or premium. So the carrying value to be used in the determination of gain or loss on disposal for investment in debt security at fair value through profit or loss is the fair value in the previous year. So, say for example, if the disposal of the investment at fair value through profit or loss happened in 2020, then the carrying value will be the fair value at the end of 2019. And now for the impairment of the investment in debt securities, according to IFRS 9, there is a single set of impairment requirements applicable to debt securities that are not accounted for at fair value through profit or loss, meaning investment in debt securities classified at fair value through profit or loss are not subjected to impairment. Only investment in debt securities classified at amortized cost and at fair value through other comprehensive income. So what are the requirements of the standard? If the credit risk has not increased significantly since initial recognition, so there is no significant increase in credit risk, then the impairment loss that shall be recognized for the investment in debt securities at amortized cost and at fair value through OCI is an amount equal only to 12-month expected credit loss. Whereas if there is a significant increase in the credit risk since the initial recognition of the investment, then the impairment loss that must be recognized is an amount equal to lifetime expected credit loss. And now, let us discuss reclassification of debt investment. So, reclassification of debt investment shall be made when and only when an entity changes its business model for managing its financial assets. So, when and only when there is a change in the business model of the entity in managing its financial asset, reclassification is effected. So first, let us discuss change in classification from amortized cost to fair value through profit or loss and fair value through OCI. So first, from amortized cost classification to investment in debt security at fair value through profit or loss, the adjustment needed in the books is that the difference between the fair value and the amortized cost is recognized in profit or loss. So if the carrying value of the investment previously measured at amortized cost is different from the fair value at the date of reclassification, the difference is reported in profit or loss. Whereas, if the change in classification is from amortized cost to fair value through other comprehensive income, any difference in the carrying value of the amortized cost investment and the fair value at the date of reclassification is recognized in other comprehensive income. Next, how about for change in classification from fair value through profit or loss? So first, if the classification is from fair value through profit or loss to amortized cost, the adjustment is that the fair value on the date of reclassification is the initial amortized cost. So that is the initial carrying value of the investment now classified at amortized cost. And since amortized cost investment needs effective interest rate or yield rate, then we are to calculate the effective interest rate based on the fair value. Whereas if the classification or reclassification is from fair value through PL through fair value to fair value through other comprehensive income, meaning there is no change in fair value because both these classifications use fair value in the measurement, so there's no need for the determination of the difference in amount. What is needed is just the calculation of the effective interest rate, which is based on the fair value. And finally, for the change in classification from fair value through OCI, first, if the classification is from fair value through OCI to amortized cost, the accumulated unrealized gains and losses in equity, because we have holding gains and losses for OCI investment accumulated in equity, they are adjusted to the carrying value of the investment and shall become the initial amortized cost. So meaning, any unrealized gains and losses for the investment at fair value through OCI they are adjusted to the fair value, and that adjusted amount will be now the initial amortized cost, the initial carrying value of the investment at amortized cost. Whereas for fair value through OCI, reclassified to fair value through profit or loss, since both are measured at fair value, so there is no change in valuation, the accumulated unrealized gains and losses in equity, the holding gains and losses accumulated in the equity section of the statement of financial position, is now recognized in profit or loss. And finally, for the presentation in the statement of financial position, so investment in debt securities are reported in the statement of financial position as follows. For investment in debt security classified at amortized cost and at fair value through other comprehensive income, they are reported in the statement of financial position as either current asset or non-current asset depending on the maturity. So if the remaining term of the debt security is more than 1 year, then the proper classification is non-current asset. But if the remaining term is 1 year or less, then the proper classification is current asset. Whereas investment in debt security at fair value through profit or loss is presented in the statement of financial position as current asset. Okay, so now let us have some illustrative problems for investment in debt securities. So let us have this illustration number 1. So on January 1, 2020, Apple Incorporated purchased $1 million of 12% bonds of Robinson Company for $1,063,394, a price that yields 10%. Interest on these bonds is payable every December 31, starting December 31, 2020. The bonds mature on December 31, 2023, and the market value of the bonds on December 31, 2020, 2021, and 2022 is 108, 106, and 104 respectively. And the requirement is to prepare the entries for the years 2020 to 2022. Okay, so first let us determine the important information about the problem. So first is the acquisition date. So our acquisition date is January 1, 2020, and the face value of the bonds is 1 million. The nominal rate is 12%, and the transaction price or the fair value of the bond on the date of acquisition is $1,063,394. So it is higher than the face value of 1 million. So the acquisition of the bond is at a premium. So our premium is 63,394, and then the effective rate is 10%. So it is actually understandable that the bonds were acquired at a premium because the nominal rate is higher than the effective rate. So our nominal rate of is 12%, whereas our effective rate is only 10%. Well, I understand that you already know the concept of um, the relationship of nominal rate and effective rate based on your accounting for receivable. Okay? So again, the bonds were acquired at a premium of 63,394, and that premium will be amortized over the term of the bond, which is how many years? It's 4 years because the maturity date of the bond is on December 31, 2023. And then interest is payable every December 31, so annually starting 2020. So interest received here will be constant at 1 million times 12% or 120,000, whereas the interest revenue or the interest income will be at the carrying value times 10%. And then the market value of the bonds are also given. So 108, it means 108% of face value. 106, so 106%, and 104%. So it's 1,080,000 on December 31, 2020, 1,060,000 on December 31, 2021, and 1,040,000 on December 31, 2022. So to prepare the entries for this bond, for this investment in debt security. So first is our entry on January 1, the date of acquisition. So our entry would be debit investment and credit cash. Actually, we can use a more specific account title. So for amortized cost, we can use investment in debt security at amortized cost, and investment at fair value through OCI, or investment at fair value through profit or loss. But for simplicity of the discussion, we may use just the investment account. So we record the investment account at the transaction price, which is 1,063,394. The problem did not mention that there is a transaction cost. But anyway, if there is a transaction cost, the transaction cost is capitalized or added to the transaction price of the bond for investment classified at amortized cost and investment classified at fair value through OCI. For investment classified at fair value through profit or loss, any transaction cost attributable to the acquisition is expensed outright. So now that we're through with the preparation of the entry on January 1 to acquire the investment in debt security, let us now prepare the amortization table. So the amortization table will show how the 63,394,000 premium is being amortized over the term of the bond, which is 4 years. So again, on January 1, the carrying value, which is the fair value of the bond, the transaction price, is $1,063,394. And then by December 31, 2020, after 1 year, the Apple Inc. will receive the first annual interest of 120,000. It is actually constant from year 1 to year 4 because the formula for the interest received is just the face value times the nominal rate. And then for our interest income or interest revenue, it's the beginning carrying value, which is the fair value on January 1, 1,063,394 times 10%. So 106,339. So the interest received is 120,000, but the interest income is only 106,339. So there is a difference of 13,661, which is what we call the amortization for the premium. And that premium amortization will be credited to the investment account, meaning it will reduce the carrying value of the bond at year end. So from 1,063,394, we deduct the premium amortization of 13,661. So the carrying value by December 31, 2020 is 1,049,733. So the concept of premium amortization basically is to reduce the carrying value of the bond until it reaches to the face value, until it equals to the face value at the end of its term or at the maturity date. So as you can notice, the amortization of the premium reduces the carrying value of the bond at each year end. So by December 31, 2021, it's 1,034,707. On December 31, 2022, it's 1,018,177,000. And on December 31, 2023, the maturity date, the carrying value is now equal to the face value. Although we have a shortcut for the computation of the carrying value, no? So it's 1 million. Say for example, the carrying value by December 31, 2020. How to compute that without preparing an amortization table. So we'll start with 1,063,394 times what is our effective rate? 10%. So times 1.10, and then we deduct our interest received of 120,000. So we'll get 1,049,733. Okay, so let's do it once more for December 31, 2021. So it's 1,049,733 times 1.1, that's 1 plus the effective rate, less the nominal interest or the interest received of 120,000, that's 1,034,707, and so on until we get 1 million face value by December 31, 2023. So we will use this amortization table to record the entries for the classification of amortized cost and fair value through OCI. And other than the amortization table, we will also prepare the schedule of the fair value. So it is given in the problem or mentioned in the problem that the fair value, the market value of the bonds on December 31, 2020, 2021, and 2022 is 108, 106, and 104. So basically, we will just multiply 108, 106, and 104 to 1 million at each year end. So by December 31, 2021, the fair value or the market value is $1,080,000. On December 31, 2021, it's $1,060,000, and on December 31, 2022, it's $1,040,000. Okay, so these fair values will be used also in the preparation of accounting entries for the fair value through OCI and fair value through profit or loss classification. And now that we already have the amortization table and the schedule of the fair values at each year end, we can now prepare the entries, so the foregoing entries at each year end. So on December 31, 2020, 1 year after the acquisition date, our entries are the following. For amortized cost classification, we debit cash for the interest received, which is 120,000. We credit interest income or interest revenue, which is 106,339. Again, that is the initial carrying value times the effective rate. And then the difference of 13,661 is credited to the investment account. That is why the carrying value for the investment account on December 31, 2020 is 1,049,733. Essentially, that is just the 1,063,394 beginning balance less the amortization of the premium for 2020, which is 13,661. Next, for the fair value through OCI classification, it's we also prepare the same entry for the interest. So we debit cash of 120,000. We credit interest income for 106,339 and the investment account for 13,661. So the carrying value of the bond after that entry is 1,049,733. But remember that the classification is at fair value through OCI, and as I mentioned a while ago, since the classification of this debt security is at fair value, we need to adjust um, the carrying value of the bond from 1,049,733 to equal to its fair value on the same date. So on December 31, 2020, it's 1,080,000. So we need to adjust the carrying value of the bond from 1,049,733 to 1,080,000. And how much is that? So 1,080,000 less 1,049,733, that is 30,267 increase. So from 1,049,000 to 1,080,000, it's increase. So we debit the investment account for 30,267 and we credit unrealized holding gain or loss, which is presented in OCI for the same amount. So after these entries for the investment at fair value through OCI classification, the carrying value now of the investment is equal to its fair value, which is 1,080,000. So if we are to follow through with our entries, so we started with 1,063,394, and then on the first entry, we credit the investment at 13,661, so we less 13,661. And on the second entry, we debit the investment for 32,67. So our carrying value for the fair value through OCI classification is 1,080,000, which is the fair value at year end. Okay? Next, for the fair value through profit or loss classification, as I mentioned a while ago as well, we only consider the nominal rate in recording the interest received and interest income. So we do not consider the effective rate. So our interest received and interest income for the fair value through profit or loss classification is the same at 120,000. And our entry for that is debit cash 120 and credit interest income 120. So as you can notice, the investment account is not affected in recording the interest received and interest income for the fair value through profit or loss classification. Therefore, by December 31, 2020, after the entry to record the interest, the carrying value of the bond is not affected. So it's still at 1,063,394. But it was mentioned in the problem that the fair value of the bond by December 31, 2020 is 1,080,000. So we adjust the carrying value from 1,063,394 to 1,080,000, or an increase of how much? 1,080,000 less 1,063,394, 16,606. So we debit investment 16,606 and we credit unrealized gain or loss presented in profit or loss of 16,606. So notice that after that entry, the carrying value now of the bond is at 1,080,000. Okay, so again, no, let us examine again our entries. In amortized cost classification, we only have the entry to record the interest received and to interest received, interest income, and the premium amortization. For the fair value through profit through OCI classification, rather, there are two entries involved. The entry to recognize or to record the interest received, interest income, and the premium amortization, and the entry to record the change in fair value. And for the fair value to profit or loss classification, we also have two entries: to record the interest received and to record the change in fair value. So, determining the carrying values at the end of December 31 or at the end of 2020 for the three classifications, we have 1,049,733 for the amortized cost classification, and we have 1,080,000 both for the fair value through OCI and fair value through profit or loss classifications. Okay, so now on the second year, on December 31, 2021, we have the same entry. So we just changed the amount. So for the amortized cost classification, again, we debit cash of 120,000. We credit interest income of 104,973. That's the interest income on December 31, 2021. And the premium amortization of 15,027 is credited to the investment account. So the carrying value after the entry to record the interest is 1,034,707, which is equal to the carrying value at the amortization table. Now, for the fair value through OCI classification, we will have the same entry to record the receipt of interest. So cash of 120,000, interest income of 104,973, and investment of 15,027 to record the premium amortization. Now, after that particular entry on December 31, 2021, the entry to record the interest, the carrying value of our investment in debt security at fair value through OCI is how much? So we will compute. So at the end of December 31, 2020, our carrying value is 1,080,000, which is the fair value by December 31, 2020. After the entry to recognize or to record the interest on December 31, 2021, okay, so as you can see, we credit the investment account at 15,027. So 1,080,000 less 15,027, we have 1,064,973. And then, according to the schedule of fair value, the fair value by December 31, 2021 is 1,060,000 as against the running carrying value, which is 1,064,973. So our running carrying value is higher by 4,973. And therefore, to adjust the carrying value of our investment at fair value through OCI to equal to its fair value, we credit the investment account and we debit unrealized gain or loss OCI for $4,973. And after that entry, the carrying value of our fair value through OCI investment is now equal to the fair value, which is $1,060,000. Okay, so that's for fair value through OCI. And now for fair value through profit or loss, again, we record the entry to for the receipt of interest, so which is 120,000. So debit cash of 120, credit interest income of 120. So again, the investment account is not affected. Therefore, our carrying value, which was taken from December 31, 2020 of 1,080,000 is still our running carrying value by December 31, 2021, even after the preparation for the entry to record the interest. But it was stated in the schedule of fair value that the fair value by December 31, 2021 is 1,060,000. So we will adjust our fair value from 1,080,000 to 1,060,000, or a decrease of 20,000. So we debit unrealized gain or loss in profit or loss, and we credit our investment account for 20,000. So our carrying value after that entry is 1,060,000, equal to the fair value at December 31, 2021. And finally, on December 31, 2022, this is the last year of the requirement, we will have these entries. So for amortized cost, it's just the same process. So our carrying value after the entry for the interest is 1,018,177 equal to the carrying value at the amortization table. And then for the OCI, same entry for the interest. We will just examine the entry to recognize or to record the fair value change. So by December 31, 2021, our carrying value is 1,060,000, and then um, on December 31, 2022, we credited the investment account for the premium amortization of 16,529. So our running carrying value is 1,043,471. But the fair value by December 31, 2022 is at 1,040,000. So our running carrying value is higher by 3,471. So we credit the investment for that amount, 3,471, and we debit unrealized holding gain or loss in OCI for the same amount, 3,471. So after these entries to recognize the interest and to record the change in fair value, our carrying value for the fair value through OCI classification is 1,040,000 equal to the fair value at year end. And also for our fair value through profit or loss classification, we have the same concept. So we record the interest of 120,000 and we record the fair value decrease from 1,060,000 to 1,040,000. So we debit unrealized gain or loss in profit or loss of 20,000 and we credit the investment account of 20,000. Therefore, our carrying value at year end is now equal to our fair value, which is 1,040,000. Okay, so now that we're through with the entries for the acquisition up to the year-end adjustments for the years 2020, 2021, and 2022, we have this additional information for our illustration number 2. So assuming the bonds were sold at 104 on December 31, 2022 after receiving the interest, what is the entry to record the sale? So we sell the bonds on December 31, 2022 at 104, which is equal to the fair value of the bonds on December 31, 2022. Well, that is realistic. Okay, so the selling price is equal to the fair value. So our entries for the three classifications are the following. So let's start with the amortized cost classification. So again, in our discussion a while ago, the gain or loss on sale for the amortized cost classification is simply net selling price less the carrying value. For the net selling price, it's called net selling price because there is an assumption that there are transaction costs that may be incurred in relation to the disposal. But in this particular example, there is no transaction cost, so the selling price of 104 is equal to the net selling price. So debit cash of 1,040,000, that's 104 times the face value of 1 million. And then we credit the investment account at its carrying value. So again, as I've mentioned also, the carrying value must be the updated carrying value up to the date of sale. Well, there is no problem about that because the date of sale coincides the date of the year end, the accounting year end. So the carrying value on the amortization table is already updated. So 1,040,000 less 1,018,177, we have a gain on sale of 21,823. Next, for the fair value through OCI classification, so we also need the carrying value. So our carrying value is 1,040,000. That is the fair value on December 31, 2022 because this is again a fair value investment. And other than the fair value, we also need the cumulative UGUL, the balance of the cumulative unrealized holding gains and losses because as I've mentioned in the previous slides, the balance of the unrealized gains and losses for the investment at fair value through OCI classification will be the gain or loss on sale if the investment is disposed of or sold. So the balance of the cumulative unrealized gains and losses is 21,823, and that is gain. So it's cumulative unrealized holding gain of 21,823. And again, that will be reported as the gain on sale. So to record the sale of the fair value through OCI investment, we debit cash for the same amount, 1,040,000. We debit the unrealized holding gain or loss in OCI at its cumulative balance of 21,823, and we credit the investment account at its carrying value at 1,040,000, and we credit the gain of 21,823. And as you can notice, the gain on sale for amortized cost classification and fair value through OCI classification is the same. Okay? Same 21,823. Why is that? Well, simply because the only difference between the amortized cost classification and the fair value through OCI classification is the change in fair value, the cumulative change in fair value. That is why the gain or loss on sale for these two classifications are the same. Next, for the fair value through profit or loss classification, our carrying value is also at 1,040,000. That's the fair value on December 31, 2022. And since that is also our selling price, so 1,040,000 less 1,040,000, so we do not have gain or loss on sale for the fair value through profit or loss account. Okay, so now let us analyze the effects of the transactions affecting the investment in debt securities to profit or loss during the lifetime of the investment, or the term of the investment, the moment it is, or from the moment it is acquired up to the moment it is disposed. So we will use the information in illustration 1 and illustration 2. So for amortized cost investment, we have interest income. Of course, it is reported in profit or loss. So for years 1, 2, and 3, we have this interest income. Again, these are determined by multiplying the beginning carrying value and the effective rate of 10%. And on the date of disposal, we recognize a gain of 21,823. So therefore, our total amounts reported in profit or loss during the lifetime of the investment in debt securities at amortized cost is 336,606. For the fair value through OCI classification, notice that only the interest income for 2020, 2021, and 2022 were considered because the changes in fair value for the past 3 years were not reported in profit or loss. Okay? They were reported in other comprehensive income, different section of the statement of comprehensive income. Okay? And also on December 31, 2022, in 2022, our year of sale, we also have a gain of 21,823, same with the amortized cost computation, or classification. So we have a total effects to profit or loss of 336,606. Now, for the fair value to profit or loss classification, other than the interest income, which is fixed or constant at 120,000 every year, we also have the changes in fair value, which are reported in profit or loss also every year. So for year 1, we have a gain of 16,606. In year 2, we have a loss of 20,000. And in year 3, we have a loss of 20,000. Also, the total amount is 336,606. So notice, even if the investment in debt securities are recorded in 3 different classifications, the total effects to profit or loss of the transactions affecting the investment are the same. 336,606. And finally, for illustration number 3, So we use the same information in illustration number 1, but we disregard the information in illustration number 2. So, okay, so in illustration number 2, we sell the bonds at 104 on December 31, 2022. This time, we sell the bonds at 105 on March 31, 2023. That is 3 months after December 31, 2022. So what is the entry to record? The sale. Okay, so since March 31, 2023 does not coincide with the end of the accounting period, we need to prepare the amortization table for March 31, 2023 line. So we will have a special portion of our amortization table. So we start with December 31, 2022. We have the same carrying value of 1,018,177,000. And on March 31, 2023, that's 3 months. So our interest received is 30,000. By the way, this is not interest received. This is just interest receivable. So interest receivable of 30,000. And then our interest income is 25,456. That is only good for 3 months. So 1,018,177 times 0.10%. Our effective rate is 10% times 3 over 12. That is 25,456 less 30,000. So our amortization is 4,544. So our carrying value by March 31, 2023 is 1,013,633,000. So we will prepare the entries for the 3-month period. So for amortized cost classification, our entry would be interest receivable, 30,000, not cash. Okay? Because the interest here will not be received from Robinson Company, but from the buyer, from the new buyer of the debt security. So interest receivable of 30,000, credit interest income of 25,456, and we credit the investment account for 4,544. Therefore, our carrying value for the amortized cost classification is 1,013,633. Next, for our FBOCI classification, we prepare the same entry for the interest and to adjust the carrying value of the bond, which is at 105. So our previous carrying value is at 104. That's 1,040,000. 1,040,000. And then to record the interest, we have a premium amortization for 3 months of 4,544. So our running carrying value is 1,035,456. And then we sell the bonds at 105. So that is the fair value on March 31, 2023. So from 1,035,456 to 1,050,000, we adjust the fair value, the carrying value, to equal to its fair value, which is 1,050,000. So 1,050,000, we recognize an increase of 14,544. So again, how did we arrive at that amount? We start with our carrying value by December 31, 2022, which is the fair value of 1,040,000, and then we deduct the 4,544 premium amortization on March 31, 2023. So 4,544. So our running carrying value is 1,035,456. And then we adjust that amount so that our running carrying value will equal to the fair value on March 31, 2023, which is at 105 or 1,050,000. So 1,050,000. Therefore, we recognize an increase in fair value of 14,544. So we debit the investment account and we credit unrealized holding gain or loss in OCI of 14,544. And therefore, at on March 31, 2023, the carrying value of the investment at fair value through OCI is 1,050,000, which is the fair value on March 31, 2023. And of course, our cumulative unrealized holding gains and losses is 36,367. So our previous balance of 21,000 plus the 14,000 increase in fair value by March 31, 2023. So cumulative unrealized holding gain of 36,367. Now for the fair value through profit or loss classification, we only record the recognition of interest income of 30,000 on March 31, 2023. We will not adjust the carrying value or the running carrying value of the investment, which is 1,040,000 to equal to the current fair value on March 31, 2023, which is at 1,050,000, because for fair value through profit or loss classification, um, changes in fair value are only recognized every year end. So any movement in fair value during the year is not recognized. Unlike fair value through OCI. In fair value through OCI, if the investment is sold during the year, the carrying value of the fair value through OCI is adjusted so that it will equal to the fair value on the date of sale. Okay, so for the fair value through profit or loss classification, no adjustment for the carrying value. So the carrying value for the fair value through profit or loss classification on March 31, 2023, the date of sale is still at 1,040,000. Okay, so now that we're through with the recording of the entry pertaining to the interest for 3 months from December 31, 2022 to March 31, 2023, our date of sale, we are now ready to record the journal entry for the disposal of the investment on that date. So for the amortized cost classification, so again, our carrying value is at 1,013,633. So debit to cash, our selling price is 105, so 1,050,000. We credit the investment account at 1,013,633. That is the updated or adjusted carrying value on the date of sale. And our gain on sale is 36,367. For the fair value through OCI classification, so again, our carrying value is 1,050,000. Before recording the sale, we adjusted the carrying value to equal to the fair value or the selling price. And then we also adjusted our unrealized holding gains and losses, and now we have a balance of 36,367. So our entry to record the sale is debit cash, 1,050,000. We also debit the cumulative balance of the unrealized holding gains and losses of 36,367. And then we credit the investment at carrying value, which is now equal to the selling price at 1,050,000. So the gain on sale of the bond or the debt security investment classified at fair value through OCI is 36,367, which is again equal to the gain on sale for the amortized cost classification. And finally, for the fair value through profit or loss classification, again, the carrying value is still at 1,040,000, equal to the carrying value on December 31, 2022. We did not adjust the carrying value on the date of sale, which is March 31, 2023, which is at 105 or 1,050,000, because as I've mentioned, changes in fair value for the profit or loss classification of debt security is made every year end only. So our entry to record the sale is with debit cash of 1,050,000. We credit the investment account at its carrying value of 1,040,000, and therefore our gain on sale is 10,000. And finally, on March 31, 2023, other than the receipt of the selling price of the bond, which is at 1,050,000, we will also record the receipt of the 3-month interest. Okay? So the accrued interest of 30,000 which was recorded a while ago when we updated the carrying value of the investment, it's we will now collect it from the new buyer. So we will record cash of 30,000 and credit interest receivable of 30,000. So that by December 31, 2023, the new buyer will receive the total of 120,000 interest from the issuer of the bonds, which is Robinson. So in our case, we collected in advance the 3-month interest from the new buyer, and then the new buyer will collect the 1 whole year interest from Robinson Company at the end of the year 2023. Okay? And again, to summarize the effects of the transactions affecting the investment in debt securities to profit or loss throughout the lifetime of the investment, we have this table. So for amortized cost, we have interest for the past 3 years and 3 months, and our gain on sale. So we have a total of 376,606 reported in profit or loss for the past 3 years and 3 months. And also for the fair value through OCI, again, we only report interest income because changes in fair values are reported in OCI. And also on year 4, March 31, 2023, our gain on sale is 36,367. So same with amortized cost, we have a total effect to profit or loss of 376,606. And finally, for our profit or loss classification, so other than the interest income reported for the past 3 years and 3 months, we also have the changes in fair value for the past 3 years in 2020, 2021, and 2022, and the gain on sale on March 31, 2023. So a total also of 376,606. Okay? So that is accounting for debt securities. Investment in debt securities.